Welcome to this explainer. When most people hear Nasdaq, they immediately picture opening bells, ticker symbols flashing, and massive tech IPOs. But today, we're looking way past all that. We're going to systematically break down how this incredibly famous yet deeply misunderstood institution is quietly, completely transforming itself from a traditional stock exchange into a bona fide financial technology and trust software powerhouse. It's a fascinating pivot, so let's get into it. Here is our roadmap for today. 1. Beyond the stock exchange. 2. The three-layer business model. 3. The trust software stack. 4. The financial transformation. 5. The one Nasdaq thesis. And finally, 6. Valuations and systemic risks. Okay, let's dive into this with Section 1, Beyond the Stock Exchange. So, what exactly is Nasdaq? If you answer that fundamental question by just calling it a stock exchange, your definition is frankly completely incomplete. Yes, absolutely. It was born back in 1971 as an electronic quotation system. And sure, it still operates vital global markets. But here's the thing. If you're out there modeling this company purely based on trading volume multiplied by exchange fees, you are missing the real investment story entirely. Here is the absolute core thesis for you. Nasdaq is now a financial infrastructure company, and what they're really selling is trust software. Think about it. Global financial markets run literally entirely on trust. Every single day, the system has to ask, is this specific trade suspicious? Is this major bank filing the right regulatory reports? Is this transaction secretly masking money laundering? What Nasdaq has done is take the immense credibility they've earned from operating highly regulated exchanges for decades, and they are using it to sell mission-critical compliance and risk software directly to banks, brokers, and regulators. They're turning that existential requirement for market trust into highly predictable, recurring revenue. If you're looking for hidden resilience in the market, this kind of invisible plumbing is exactly what you want to pay attention to. So to sum that up, they've evolved from a 1971 quote system into a true hybrid of markets, data, and software. They are solving existential compliance problems for the entire financial system. Which brings us to the architecture of the business. Section 2, the three-layer business model. To really understand how they actually monetize all of this, you have to think of modern Nasdaq as a three-layer model. It's like peeling an onion. First up, we have the market layer. This is the traditional stuff, the exchanges and trading services. It generates your transaction revenue, but more importantly, it builds the brand and generates raw data. Second, sitting on top of that is the information layer. This is where they sell market data, index licenses, like the famous Nasdaq 100, and corporate listings. It's a fantastic, high-margin business. But then we get to the third layer, the trust software layer. This is where Nasdaq provides anti-money laundering, fraud detection, regulatory reporting, and market tech. This specific layer is where they turn complex regulatory headaches into sticky, recurring revenue. So the big takeaway here, the market layer gives them the brand. The information layer gives them high-margin scale. But it's that third layer, trust software, where the real structural transformation of this company is happening right now. And this brilliantly illustrates our next point. Section 3. The trust software stack. Let's actually pop the hood and look at the software acting as a compliance toll booth for regulated finance. First up is Verafin, a massive acquisition they made back in 2021. This is their cloud-based anti-financial crime platform, and it is absolutely mission-critical. We're talking fraud detection, anti-money laundering compliance, investigating suspicious activity, the whole 9 yards. Financial crime is a permanent problem that's constantly evolving, and regulators are always raising the bar. To put that into perspective, in just the first quarter of 2026, Verafin generated $93 million in revenue. That's a 21% jump year over year. It is the ultimate real-world example of monetizing trust. Next, sitting right in their regulatory technology division, we have AxiomSL. This came over with the massive Adenza acquisition in 2023. AxiomSL manages regulatory reporting, capital, and liquidity data for banks. And let me tell you, regulatory reporting is an unavoidable structural pain point. Think of it like having to file your taxes, but you're doing it continuously on a massive global scale, and the rules keep changing. Banks literally do not have a choice. They have to accurately report their risk to regulators across multiple jurisdictions. Once this software is integrated into a bank's architecture, it is incredibly sticky. Then we've got two vastly different yet equally vital operating systems to look at. On one side, there's Calypso, also part of that Adenza deal. Calypso is essentially a front-to-back capital markets operating system supporting everything from trading and treasury to clearing and derivatives. On the flip side, you have Nasdaq's surveillance tools. Because Nasdaq actually runs physical and electronic exchanges, they know exactly what to look for when it comes to market manipulation, spoofing, and even crypto abuse. They literally package up that in-house expertise and sell it outward to other exchanges, regulators, and brokers. Together, these tools run and protect the daily operations of complex global finance. So just looking at this stack, Nasdaq's footprint is undeniable. They aren't just a trading venue, they are the anti-crime infrastructure, the regulatory pipelines, the capital markets OS, and the market abuse detection system. Now, what's really interesting about this next slide is the proof in the numbers. Section 4, the financial transformation. So, how does all this sophisticated software translate into hard financial results? Well, if you want the ultimate aha moment that proves this business model has fundamentally changed, just look at the pivotal shift from full year 2025. Financial technology revenue officially reached approximately $1.85 billion. Compare that to their traditional market services net revenue, which sat at roughly $1.20 billion. That's a real milestone. The technology and software arm of the business is now demonstrably larger than their peer exchange transaction revenue. And because they're acting much more like an enterprise software company these days, annual recurring revenue, or ARR, is the master metric we need to watch. In the first quarter of 2026, Nasdaq's ARR reached an impressive $3.19 billion. That represents a 13% jump year over year. What this tells us is that they are successfully migrating away from the unpredictable, wild swings of daily trading volumes and moving right into highly predictable, subscription-like contracts. Furthermore, 38% of that annual recurring revenue is specifically annualized software as a service, or SaaS revenue. Now, why does this matter? This SaaS mix is critical because it proves Nasdaq isn't just doing clunky, one-off custom technology builds. They're deploying scalable, sticky, cloud-based software platforms that these massive institutions are going to happily pay for month after month, year after year. The accounting absolutely doesn't lie. With total solutions revenue hitting around $4.01 billion in 2025, Fintech officially eclipsing market services, and an ARR compounding past $3.19 billion, the evolution from a simple exchange into a resilient software compounder is officially complete. Let's move on and see how this all builds together strategically in Section 5, the One Nasdaq thesis. This brings us to their overarching growth strategy. It's the whole strategic catalyst behind these massive acquisitions, and they call it the One Nasdaq thesis. It's essentially a massive institutional flywheel. Here's how it works. Step 1, Nasdaq operates trusted, highly regulated financial markets. Step 2, operating those markets generates vast amounts of proprietary data and builds unshakable credibility. Step 3, they use that exact credibility to sell mission-critical tech and workflow tools like Verafin and Calypso right back to the banks and market participants. And finally, Step 4, the cross-sell. Think about it. If Nasdaq gets Verafin inside a bank to detect fraud, they now have the foot in the door to sell that very same bank AxiomSL for regulatory reporting or Calypso for treasury management. This unified platform strategy is brilliant because it drastically deepens their relationships with the world's largest financial institutions. By stacking these services, Nasdaq dramatically reduces its dependence on pure trading volume, creating this massive hidden upside as the revenue generated per institutional client just keeps expanding. But of course, no transformation is completely risk-free. Let's hit Section 6, valuations and systemic risks. Looking at this through a macro valuation lens, the upside is pretty clear, right? If Nasdaq can keep compounding its ARR and successfully execute those cross-sells, it deserves a premium software multiple, way above what a traditional exchange would get. But we have to be realistic. The risks are very real here. For one, the Adenza acquisition brought on significant debt that requires really careful management. On top of that, enterprise software comes with massive integration headaches and notoriously long sales cycles. And perhaps most importantly, because their entire product is based on trust, any severe cybersecurity failure or software hallucination in their anti-money laundering tools wouldn't just be a minor bug. It would literally be a catastrophic hit to the core credibility of the entire Nasdaq brand. Which leaves us with the ultimate question to ponder today. We know the strategy, and we've seen the hard proof of that $3.19 billion in recurring revenue. But looking ahead, Can Nasdaq continue to seamlessly convert its legacy exchange credibility into high-growth, sticky software revenue faster than the very real risks of enterprise integration, market structure changes, and acquisition debt catch up to them? That right there is the defining question for the future of this financial giant. Thank you so much for joining me for this explainer. Keep your eyes on the data, and we'll see you next time.